Hello, this is Jed Brewer with the Below the Line Club and Study Groups. Very nice to have you on the call today. We're going to be talking about mergers and acquisitions and also a legal update in our always dynamic and changing environment. There's been a lot of deals going on. You probably have been seeing press releases coming out of your competitors selling, or perhaps you've been doing deals as well and being the acquirer. So it'd be really nice to have Spencer Cavalier, who's the managing director at Matrix Capital Markets Group. They're based out of kind of Virginia, Richmond area, but work with petroleum marketers and convenience store retailers and other firms and other industries across the country. So it'll be nice to hear from Spencer about what kind of activity they've been experiencing and what multiples are looking like, and forecasts for the future at the same time. And then similarly, we've got Jim Dierking, who's a shareholder at Winthrop Weinstine out of Minneapolis, Minnesota. Jim is a lawyer, and he's going to provide us a legal update on considerations we need to keep in mind going forward. So should be a really good webinar. As I said, a lot going on, whether on the legal front, from climate change and electric vehicles to the Build Back Better program. So Jim will give us an overview on that, as well as data privacy concerns, and then Spencer handling more of the M&A transaction landscape. We want this to be very educational for you. We will send out this recording and the slide deck to you afterwards. But if you have any questions, please type them into the dialog box in this GoToWebinar framework. I will be able to read those, and I'll relay them to Spencer or Jim at the appropriate time, because again, we want to get your questions answered. If there's any questions you have that we don't get answered, I know Jim and Spencer would be super happy to follow up with you one-on-one offline as well. So with that brief introduction, Spencer, let me turn it over to you to provide us an update on what you're seeing mergers and acquisitions landscape.
Okay, great. Thank you very much, Jed, and thanks for having both of us, both of our firms back for 3 years. I think Jim's done it a couple times, and we appreciate it very much. And so
yeah, you're welcome. You're one of our most highly attended webinars, so I think people really value what you have to say.
Yeah, thank you very much. Just before we get going, a little bit about the terminology we'd like to cover as a refresher. I mean, everybody knows the terminology that's on the call, but just to make sure we're grouping them the right way. So what we're going to cover the CNG market, which are, obviously companies primarily engaged in petroleum marketing, convenience retailing. And that's very associated with fuels distribution. So we talk about these two a lot kind of together. But when we think of fuels distribution here at Matrix, we're really thinking more about people who wholesale branded and unbranded motor fuels to retailers or to contract dealers and commission agents, primarily through transport loads. And then we're going to talk a little bit about the propane market, and these are companies that are primarily engaged in retail propane, but also may have a little bit of a wholesale component to their business. But they may also distribute refined fuels via tank wagon and transport loads. So we kind of put a little bit of that together, but mostly this is dominant propane. And then under the commercial fuels and lubricants bucket, these are, again, companies that are heavily into lubricants, but may also be into the distribution of refined fuels through bobtails and transport loads. So, because those products tend to go together a lot. So we kind of bucket those there. So there's a little bit of overlay between propane, refined fuels, and commercial fuels / lubricants bucket, but I think a lot of people on the call work in both of those buckets or markets and can understand where we're going. So to start out with the CNG and fuels distribution segments, and I'll get to my slide here. We like to talk about the factors that are driving consolidation, and we like to break those down between those that are permanent and those that are subject to change. And some of these are consistent with prior years because they have been prevailing for a while, but there's a little bit of twist to some of these bullet points. But the first one we like to talk about is that are the factors that are likely permanent are industry maturity and flat to declining overall fuels demand. And we talk about this, and some people, when we talk about this, there are marketers in certain parts of the country that are saying, look, we're growing, our volume's growing. And that's true. But on the whole, if you look back at the data of finished motor fuels that have been sold in the US over the last several years, we've been kind of flat around 9.2 to 9.3 million barrels per day. And it just hasn't grown. And I think that we're growing, the number of registered drivers are growing and things of that nature more slowly, but because of the efficiencies of the internal combustion engine and the started a little bit of penetration from EVs and hybrids, there's a little bit of pressure, and that's kind of kept that on the whole, on the aggregate, that demand kind of steady. There's fluctuations with COVID and things of that nature, but if you look back for quite some time, we've been in that 3.2 to 3.4 billion barrels a year, basically. So that's where we are. And I think that's given a lot of marketers concern about just, we have, margins have increased, but when there's a steady or declining volume in certain markets, it causes certain people to want to sell. The other factor that we see a lot of is the need to increase store count and grow volume and cash flow. There's a lot of the companies today are backed by investors and they're demanding returns. So there's, an imperative for growth, and a lot of companies cannot do it through organic growth or new to industry sites. So unless you're a larger company like a Wawa in the east, or a Come and Go out west that have a lot of area marketed developers working for them, it's very hard to grow just through organic growth, especially for the regional marketer we have found. So that has caused pressure and caused consolidation. The need to continue to spread corporate overhead across multiple sites. So while margins and fuel margins have gone up, and that has helped significantly, there have been a number of increases for corporate overhead or back office costs. And at the end of the day, it's about corporate level EBITDA across your whole company. And I think there's been pressure to grow, and there's always pressure to grow. Whatever industry you're in, those costs are increasing. But over the last few years, there are certain expense components that have gone up more than usual, and that has put more pressure and caused more consolidation. Large fuels distributors, we've seen the ability for them to capture significant synergies via purchasing power and operational controls, much better than smaller regional fuels distributors. And we're going to talk a little bit more, I'm going to talk a little bit more later about capturing synergies, but you've seen like the Offens of the world grow because they can capture synergy and purchasing power. And so, and we also have seen refiners start competing more directly with distributors in certain parts of the country, especially merchant refiners. They have also competed against the large fuels distributors and put pressure on them, causing even more pressure to consolidate and grow. And I think we're going to continue to see that, as you've seen Shell and BP and other, exploration refiners do more JVs and acquisitions of retailers across the country. We have more public companies today really than there was one point in time where we had a few more, but we have more today than ever really, and there's a few more that are coming to market or want to come to market. You may have seen the announcement by Yesway. And so as these companies, the more public companies we have, the more pressure there is for them to grow and acquire companies. And so we will see them be more acquisitive. We have seen some traditional long-term public companies become more acquisitive, like Casey's, and we'll talk more about that later. Cost of capital differences, this is one that's been on this slide for a while. That's always going to be the case, and it's permanent between smaller and larger operators. Larger operators typically have a lower cost of capital and more access to capital markets. Generational issues. There's just a lot of, this is a great industry because there's so many private family-owned businesses, but a lot of times the second, third, or fourth generations, that you come to a point where there's not a family member who wants to continue on with the business or doesn't have the passion to continue on with the business. So we see a lot of consolidation and because of those issues. And then while this last bullet about regulatory pressures surrounding renewable fuels and electrification, this one, there's probably more pressure here the last time we spoke about it. There's been a little abatement because of some of our electrical grid and other issues around the country, but there's still going to be increased regulatory pressures for states and other areas to adopt renewable fuels and to continue electrification. And so we'll be fighting that for quite some time as an industry to make sure it's fair. Some factors that are subject to change. We have enjoyed very, very low tax rates over the last few years. And one of the great nuggets in the tax legislation has been the ability to accelerate depreciation. And this is basically for qualified property, and it's basically for makers property with 20 years or less and certain improvements. That's going to start to phase out, started in 2023, and it phases down about 20% a year. So that has allowed certain buyers to accelerate more, lower taxes, and get a higher IRR, especially at the beginning part of the acquisition. So that's been great for them, and it was something I'd like to see extended. There's an uncertainty about taxes under Biden, as everybody on the call knows. It's a major issue, reason for the heightened activity in M&A last year. Especially in the final quarter, and we're going to see some stats on that coming up. The uncertainty continues on. It seems like there's less pressure this year, or less concern, but it hasn't been resolved yet, and it'll be interesting to see how things evolve over the next few months. And I'm going to skip down to the next to last bullet, is the ability to sell with strong performance over the last few years, especially retail fuel margins. So we've had for convenience retailers or even wholesale fuels distributors, we've had significantly higher margins over the last few years. And we were actually higher in 20 than 21. We came back a little bit depending on where you are in the country. And we know that margins need to remain higher because of the increased operating costs at the store level or at the operational divisional level. However, we just don't know exactly where that's going to kind of stabilize. It can't continue to grow to 30, 40, 50 cents a gallon across the country. So a lot of long-term marketers believe that this is a great time to sell off that stronger rising retail margin trend, and they have taken advantage of that. The last factor we think that's subject to change.
Spencer, just to interject here, I'm curious your outlook on retail margins. Obviously, you're in the M&A business, not in the fuel retailing business, but I know there's two camps. Some people that, hey, this is a moment in time, and so margins are going to return to quote unquote normal. But then there's the other camp that says, hey, we got fewer players, more sophisticated players. They've paid high multiples for the business. It's more of an oligopolistic market structure, and higher margins may be part of the future for us. I'm curious what your view of the world is.
I'm probably more in the latter camp, Jed, because there has been so much consolidation. If you remember, and I think a lot of people on this call knows, I mean, the reason margins would go so low in the past is because the major oil companies had control over a lot of different markets, and they could invert those markets when they needed to put product through, right? And so it would really push down markets. And today, they don't have as much control because they sold off a lot of the retail sites, or their brand restrictions are coming off in a lot of the markets they sold out of, but they are starting to come back into the market through JVs and things of that nature. So I don't think they'll ever have a grasp on the retail fuel margin again like they used to. They'll have some influence, but net, I think margins are going to be higher. Last year, I think the average was about 28 cents nationally, with the Northeast and the West leading the way at 34 cents per gallon, and the Southeast was around 23.7. Southwest was around 21.6. I think they're going to have to stay up in the range to cover the cost. And, again, it's all about cash flow. I mean, the margins are nice, but we've got to make the cash flow and return for investors. So I think they're going to be heightened. I just don't think there's a camp out there, Jed, that thinks that these things are going to go up another 10, 15 cents per gallon quickly. And I don't think that's going to happen.
That makes sense. Yeah, thanks, Spencer.
So let's move to the next slide. and this, I think a lot of people want to know about the activity net last year. But this chart right here shows M&A activity by quarter back to 2012 for both CNG and fuels distribution companies. There has to be a certain criteria to make the table. So this is not every transaction, and we don't catch every transaction out there. Some are just never announced, actually. But to be in here, you at least have to have the transaction. At least had to have 10 convenience stores, or had to have 25 supply accounts, maybe 2 trucks. There's a baseline of criteria we use. So that's an example of that. It had to be convenience stores or fuels distribution business had to be a substantial component of the transaction. So there may have been an ancillary division of a company that sold, but if convenience stores or fuels distribution was a major component, they made the criteria. They made the table, and then sale leaseback transactions are not included. And for private equity buyers, we consider them strategic buyers. So we break down the type of buyer, which is not in this chart, but we consider them a strategic buyer after their initial investment. So if you look at the activity and look across and look at the average per year, the average since 2012 has been about 34 to 35 transactions a year. But 2021 was a record year, especially if you look in the fourth quarter. We had 31 transactions close that we followed, and so for a total of 55. So that's about 20 more last year than the average for the last 10 years, and it really was driven by a lot of things we talked about on the previous slide. But with that last quarter activity, you can tell it was bolstered by people wanting to get out because of a concern over tax increases. The interesting thing
That certainly was our experience, Spencer. Just anecdotally for study groups, I mean, you've got more of a broad sample, but we got about 300 unique companies that are members of our group, and our average is to have about 10 to 12 members sell out each year. And of course, the motivations for that are multiple. But in the last 2 months of last year, we had 14 members sell in November and December. And you start saying, well, what was different about November and December than the last 10 years? And I think there was a lot of concern about capital gains tax increases, what was going to happen that ultimately never materialized. That's not the sole factor going into it, but the straw that breaks the camel's back in some cases for firms.
Yeah, absolutely. And the number of deals could have been well over 55. I mean, maybe 60, 65. There were a number of deals that didn't get done just because there wasn't enough bandwidth to get them done from the professionals, the legal lawyers, title people. We just couldn't get. We had a couple, but with people that knew we may not get them done, and we may have started a little bit too late. I think, Jim, you probably have a similar experience at the law firm. You just couldn't get everything done, every transaction.
Indeed. Yeah, indeed. And the most common factor we heard certainly was capital gains, but there was a lot of other things going on too. And there were a number of transactions that did have to sort of flow back into this year.
Yeah. So the first quarter of 2022 is still pretty strong. And I think some people took a pause after 12/31 to kind of see what they wanted to do. So it wasn't, it'll be interesting when we do the counts at the end of the first quarter and compare them, how it's going to come out. But I think some people are just waiting to see what, how the tax legislation is going to go with Build Back Better. But so that's really the activity from a CNG and fuels distribution standpoint. One of the things that we've talked about in other of the webinars here is that are these, we have all these people selling out, but we have all these buyers. We have more potential buyers than we ever had, and it's true. There are more public companies. There are more existing public companies that want to grow that may not have been an acquisitive type company in the past. We have private equity involved more than ever. And so it begs the question, why? And it's because we've talked about this before. It's the synergies that these acquirers believe they can achieve in this industry. And not only that, I mean, everybody knows that this is a very resilient, good industry through different types of economic cycles. So they like that. And many people coming into the industry truly believe in convenience. I think, Jed, we've talked about that. That's, you and I are big convenience believers, regardless of what the fuel is going to be. We think this is going to be a very vibrant, healthy industry. But so, the public companies that buy other companies oftentimes will do slide decks and investor presentations to talk about the transaction. And in those presentations, they talk about why they're buying a company and the type of synergies they're going to hopefully achieve. And then they explain how much they're paying for the company and what that multiple is, and then what really is the net multiple for them after they achieve these synergies. And so we cover a number of these. I put 3 of these on this slide here on this presentation, but the one I kind of wanted to talk about was the Murphy USA Quick Check acquisition. And so if you look at that column, Murphy paid $625 million. That's what they reportedly paid for the company. At the time, Quick Check was doing 47 million of corporate EBITDA. So it's corporate level EBITDA, not store level EBITDA, and that's a lot of confusion in the market. When you hear multiples, you never really know if you're hearing a store level multiple or corporate level multiple. But the good thing about public information is usually all corporate level, so it's clean. So on a corporate basis, they paid 13.3 times. They made a presentation. They said, we believe we can bring $28 million of synergies to the chain. The chain was 157 stores. Well, that's a huge proportion. It's almost 60% of the 47 million of EBITDA they were buying. They thought that they could enhance through synergies. So basically, when they were done, and this was a 3-year program they laid out, they would generate 75 million of EBITDA from the Quick Check stores. So we follow up. We watched them. Murphy had a conference call in February. They said they've already captured about 8 million of the synergies in 2021. So they're they're capturing synergies through the 3-year plan. The synergies they highlighted that they captured already were retail pricing. They think they've optimized fuel pricing on the street by using elasticity models that they like to employ. But most of the synergies came through securing more favorable terms on supply contracts and inventory management. That's where they got most of it. So basically, it goes to what we were saying, that size matters anymore, and they're capturing it. It'll be fun to see if they actually capture the full 28 million. We'll keep looking at this, but I do know that certain other deals, there's probably 10 of these that we follow. We have done a couple of them. Marathon was very good at capturing synergies. They did a great job in a couple of the deals that they did earlier. So we're seeing synergies being captured. So this is good for sellers. You don't get, you don't obviously get credit for all the synergies that a buyer is going to capture, but you get some, and it's a good thing.
Yeah, and it's interesting because people look at Quick Check, for instance, which is, say, boy, that's a finely run company. How could there possibly be that many synergies in a very well-run company? And I think your point about size matters in terms of scale and the ability to lower cost of goods sold, and it's to a degree not a fair playing field in that manner.
Correct. Yeah, it's not like it used to be 30 years ago. So on the next slide, many who've been on this webinar before, you've seen this slide, and we're always updating it. And these are the select companies driving consolidation, primarily in the CNG market. And there are a lot more buyers, but these are the ones that are most active looking at deals, in our opinion. And I've highlighted the ones that have been the most active over the last 12 months. And just to go through a few of them, Arco, which obviously went public via SPAC not long ago. That's GPM Investments. They're probably the most active. Just closed on EJ Pope. They bought Corrigan's retail chain. So and a number of other ones. Casey's is a good example of a public company for a long time that didn't do a lot of acquisitions or major acquisitions. They did 2 over the last 18 months, being Pilot and Buchanan Energy, really big deals. If you look to the middle, the major oil companies, Shell just acquired Landmark down in Texas, but they've done other deals through the JVs. Phillips 66 has gotten very active through their partner Fortress, and over the last 18 months acquired Peaster Marketing and Western Oil. Over on the right, U.S. private companies, Jackson's Food Stores has been very acquisitive over the last 18, 24 months. Actually, Majors Management, extremely active. They just bought Tri-State as one, to name one. Mountain Express, they bought Brothers Food, and they're private equity, kind of private equity backed. But really private money. That's why they're in the private company section, not private equity. And MLPs, Global Markets, still very active, and they just closed the Wheels transaction. Under private equity groups, ArcLight, I want to highlight them because they had been an investor, as there are a lot of people know, in Thornton's. They were more of a capital provider with BP. They sold out their interest to BP, and now, but they liked what they saw being an operator and a direct owner, so they bought Pride convenience stores recently. Fortress.
It's fascinating to me, Spencer, to look at this list, though. I mean, there's a lot of sophisticated quality companies in here, and going back to your earlier point where I hear from our members just a lot of fear about, well, what's the future of the industry, and can I make any money, and is my business value going to go to zero? These people are betting on the future, and they're paying pretty handsome multiples that
Right.
It's not going to go to zero in the near future. So I appreciate that concern, but I just don't see it given what people are doing. It doesn't feel like a distressed industry with the buyers that are in here.
No, I think a lot of people, if you just said, well, how long can we sell carbon? How long can we sell gas or diesel? I mean, 20, 30 years, it may go down, the margins should go up. But a number of these buyers, to be fair, on the right, lower right side, private equity, and then like EG Group, or they're not going to be in it long term, right? They're going to sell. They're going to sell out at some point. But you're right, though. If you look at the major oil companies, all the public companies, the MLPs are a yield play. It's stable. There's a lot of good operators. But I think that what everybody on this page knows, you have to have scale to survive. There's just too much pressure on earnings. And even Casey's, it was either the last release or the release before, their stock got hit a little bit because they reported increased expenses for the first time. It put pressure on their EBITDA. So, it's a concern for everybody. On the next slide, slide 9, I went ahead and wanted to put fuels distributed like centric acquirers. And on the top left, a lot of people will know World Fuels, who just bought Lycans and Flyers, DCC, bought United Gas and Affordable Gas. Parkland has done a lot of deals over the last 12 to 18 months. They bought Story Distributing, they bought Brandonton Fuels, so very active. They, Jed, you were just talking about Canada is really, talk about consolidation. They're well ahead of the U.S. And I think Parkland just views the U.S. as Canada, 10, 15 years ago, and just a huge opportunity for them to consolidate and more focus, frankly, on commercial fuels and distillates, obviously. But, on the private company side, still some really strong private companies. Colonial Group, they bought part of Lycans. Mansfield Oil has done 3 or 4 deals, primarily in the tank wagon business, O'Rourke and Jam Distributing. Obviously, Pilot Flying J bought SC Fuels on the West Coast, which is one of the well-known private companies out on the West Coast, one of the biggest. And then private equity, Jed, like we were talking about, I don't know, a long while ago, they've gotten strong into this area as well, with Often being backed by Court Square, Transit Energy being backed by Energy Capital Partners, and they're all acquisitive, and they've really done a nice job. And we've been on the phone a lot lately with these international companies, Prax and Puma, who are really looking to grow in the U.S. So the these companies are seeing a brighter future, than some other ones. But again, it's about scale. Moving to the next slide, and this is something we talk about a lot. We were talking about earlier, but this is a chart of the three primarily what I call M&A waves since 1995. And I've been around for most of this period of time. I started really like 97, 98 in the industry. So I went back and I've been updating this chart for a long time. But you can see we had the blue line is the median enterprise value to EBITDA multiple. So the transaction multiples of these publicly traded companies and where they're trading. The black line is kind of the average enterprise value to EBITDA multiple during a specific M&A cycle. And the orange dotted dash line, whatever, is the number of public companies at a time during those periods. So a lot of people know we had a M&A upcycle between 95 and 99, fueled by debt, easy debt, securitized lending. The average multiple for the publicly traded companies was about 9 times during that phase. Then we went through a recession between 2000 and 2004. Easy money came back in 2005 through 2008, and the average corporate level multiple was 8.2 times. And then we took a break again for the financial crisis, and then we came back in 2012, and we've had a nice run steady for that since 2012 to now, pretty much averaging about 9.7 of enterprise value to corporate EBITDA. So it is the highest level for the publicly traded companies in terms of a corporate EBITDA multiple. And you can see the orange dashed line is up, and it's not as high. The highest point was back in around 2014 when we had 11 publicly traded companies, and we had like more MLPs, and they consolidated, and we had a couple other companies that got acquired, larger companies that got acquired, like the Pantry, due to activist shareholder activity. So now we're at 9 publicly traded companies that focus on either, they're centrically focused on retail, or they're more focused on fuels distribution, or there's some type of combination of the two. So the last thing I'll say about this is liquidity is really important. I mean, everybody talks about multiples, and if you're in a non-liquidity environment, most of the time multiples come down, but we have a lot of liquidity in the market, and that helps drive multiples. Drives competition, and that's what you want. If you want to sell your company, you want to make buyers compete. Okay, the next slide is the corporately traded companies, the retail and wholesale fuels distribution multiples for publicly traded companies, like I said. And you can see that from 2013 to 2021, the multiples have fluctuated because there's at certain times, certain things happen like COVID or other things. Or something may happen with a specific company that creates a peak in the black line or makes it go below. But the average has been 9.5 times over this 2013 to 2021 period. The median multiple today, as of the end of Q3, we don't have balance sheets yet for all the public companies at the end of fiscal year 21, but the median corporate level multiple for the 9 publicly traded companies was 10.6 times. So just as a comment, we do not publish multiples that we achieve for our customers, our clients, because those are confidential. But the public multiples are a good proxy. And there are lots of deals we sell higher on a corporate level, on a corporate multiple basis, higher than 10 times. Some we don't. Depends on the company. But it gives you a good proxy on the direction of, and if the market is elevated or not. And we are, based on the public companies, we are in an elevated market. The next slide is a little more detailed, Jed, and I think I'm going to not go through this. This just gives a little more breakdown of how the market cap for each of these companies is, and the debt load and the yield. I think this would be better for people to just consume. They can call me with any questions.
Makes sense.
So maybe pause there. Jed, do you have any questions? I'm going to go into propane a little bit.
Yeah, go ahead and go into propane. I do have a more general question, but I think it fits for propane too that we'll pick up.
Great. So on the propane side, you know, a lot of these drivers that we've talked about, the factors driving consolidation, they haven't really changed much. You know, it's a much smaller industry. It's more fragmented. But for a long time, they have the propane retailers and wholesalers, obviously, they've been feeling a lot of pressure from electrification and natural gas expansion, right? And not only that, those are viewed as cleaner fuels, and propane is sometimes perceived as a dirty fossil fuel, even though if you really know the carbon intensity levels, propane, especially renewable propane, is very low from a carbon intensity standpoint. So this is why some of the bigger private family-owned propane marketers have exited. They've expanded through acquisition, but they're not expanding organically as much as they had been in the past. Auto gas has been growing, but it hasn't made up replaced gallons lost to some of the efficiency gains and other energy sources. Now, again, this is different depending on where you are in the country because it's very hard to heat your home with a heat pump in the Northeast, but you can do it from the Mid-Atlantic down, you know? And so this is one of the reasons we've had consolidation, and there's also been scale advantages. Over the last couple years, and maybe more than that, 3 or 4 years, the propane market has really benefited by the heavy fracking and the increased amount of propane that was in the market, and it lowered the wholesale procurement costs. That changed over the last 12 months a little bit, and that has put pressure on margins. It's there's been more propane is being exported. There's been inventory issues due to the issues around COVID. There's been higher costs with drivers. So, last year has been last 12 months in propane has been a little more challenging. And so we don't know if fracking is going to come back into the levels it has been, over the last 5 years. And we don't know if there's going to be excess supply again to put, to lower the cost, the procurement costs, we're hoping. So that and degree days being down a little bit over the last 10 years or 20 years, that trend has pushed a lot of these smaller propane marketers and mid-sized propane marketers to sell out to the big consolidators. I'd like to mention though that the Propane Education and Research Council, PERC, has done a really nice job of trying to educate the government that fuels are not a binary thing, that you can't just go from fossil fuels to electric. And Tucker Perkins, who's president and CEO, they've created a new campaign around carbon intensity and how conventional and renewable propane really fits into the picture. And Jim's going to talk more about that a little bit later. And I think the infrastructure legislation that was passed is going to be good for the propane marketing industry, just if everybody rallies behind and pushes the legislators to recognize that propane is a clean fuel and it should be part of the equation to get to a clean fuel energy policy. Jed, any questions there?
No, I know Jim will talk more about propane. I want to be cognizant of his time. So let's move on.
Next one is the slide 14, just highlighting the most active consolidators. And I think a lot of people know who these folks are. On the next slide, we've listed 29 of the transactions that we've tracked. These are maybe a little bit larger. LP Gas suggested that, or states that there were 49 transactions in 2021. We tracked 29 of these. So we can talk a lot about these if anybody wants to on the side. And then this slide is the publicly traded company multiples, public multiples, and this is corporate EBITDA divided into enterprise value, just like the other charts that we talked about. And you'll notice the multiples have gone down for these public companies. The average multiple has gone down. But if you look down into the table, you'll notice that it's really, there's 5 publicly traded companies right now in propane. And a couple of these are really kind of hybrids between refined fuels and propane. And 3 of the companies are not growing very fast at all. And their multiples are being lowered by Wall Street because they're not growing. That's Farrell, Star Group, and Suburban. But if you look at the multiples for DCC and Superior, who have done a lot of acquisition and growth, they're in a double digit. So I can assure you that most of the propane companies that we've sold, most of the private transactions have not been, at the median multiple here that you see on the lower right-hand part of the table, the 6.9 times. I can tell you that we have achieved multiples higher than that on a corporate basis on all of our transactions. So the public, in this situation, the public comps are not as reliable as a gauge like the public comps for convenience and gas and fuels distribution. And then lastly, on the lubricants market, not much here to add, but it's continuing to consolidate. The suppliers continue to tell us they just really want to concentrate their distribution among a fewer larger partners, and who will provide more services and be able to handle these more complicated, customized lubricants and ancillary products. So it's another game of scale. There's not a good public there's not a lot. There are no public companies really that we can show comparables for. We have a lot of transactions, but I don't want to share those multiples really, although they have been strong, I will assure you. But on this page on 18, you can see there's been a lot of activity, especially by the private equity backed lubricants distributors. And just so you know, 2 of the ones that are highlighted, Relodyne and Cadence, recently sold themselves to large private equity funds. So they, like Relodyne in particular, sold from Audax, which was a private equity fund, to a larger private equity fund, American Industrial Partners. So that shows you that there's significant interest by some pretty big private equity funds in this industry, and they think there's a lot more growth and consolidation to come.
Going back on your slides to the bullet points, I found your first bullet point and your last bullet point to be interesting, Spencer. The first bullet point was the estimated 50% reduction in the number of lubricant marketers in the last 10 years. Anecdotally, that feels about right to me. And then your last bullet point is actually optimistic, talking about some of the regulatory things that may portend higher lubricant demand on the commercial and industrial side.
Yeah, if you look at some of the forecasts by, I can't give you a good right off the top of my head for lubes, especially more sophisticated, complicated lubes. They're actually projecting growth, and I could get more details that you could share with people. But yeah, it is a positive in the lubricant industry.
Yeah, thanks.
So that's really all I had. I have a shameless
one
plug
question
here.
I have for you before we move on to Jim.
Sure.
But so the people that are selling out, you visit with a lot of them about what their plans are, and I'm sure everybody has different plans. But how are people reinvesting their money? Are there any common themes that you see? Because they're earning. I mean, at least our study group members are earning very attractive returns right now in their businesses. So if you sell something that's earning 15, 16% return, where are they putting their money to get a return?
That's a good question. So a lot of these companies they create their own family offices, Jed. And the way they're looking at things is that on a risk-adjusted return basis, I'd rather get 10% in the equity markets or buy another operating company where I can be a passive investor and I can just be my own basically private equity fund. And many of those are transitioning in that way. I mean, what we're hearing is that a lot of them just don't want as much exposure. They don't want all of their family wealth, or even the ones that are owned by private equity and want to carve out. They want to take capital and just have it in, higher risk adjusted returns from a risk standpoint, higher returns in that regard. So that's what they're doing, and they're buying real estate. They've done well in the public equity markets, and they're putting money into alternative investments very tax efficiently.
Yeah, I've heard, one guy, for instance, sold, he's earning 15, 16% in his operating business and became a landlord and, bought some real estate at a upper 4% cap rate, right? But it's a much less risky investment. You say, hey, I'll take the lower yield for more security.
Yeah, but you're right. That's a lot of folks in the industry already have investments outside the industry. They're very sophisticated, so they're not just buying low cap rate real estate. They're rolling money into other operating companies and other investments where they're getting a higher return, and they think the risk is lower. So it's very interesting.
For sure. Well, thank you, Spencer, so much. Jim, let's move on to you for the legal update side.
That sounds great. Thank you, and thanks, Spencer. I will cover. I want to cover these topics sort of at a high level today. I would say, a lot of the work that we do at Winthrop and Weinstine in the downstream energy field is M&A type of work, but we are a pretty full-service law firm, and we do handle a whole host of other issues for clients in this industry as well. So I am talking about some of those other issues, a couple of them, and just kind of trying to provide some high-level updates today. So we'll dive right in, I guess, to the first topic here, which is a brief propane funding update. And what I just wanted to point out here, and Spencer alluded to this earlier, is that the Infrastructure Investment and Jobs Act, passed late last year, does include propane as a qualified alternative fuel, which then what comes along with that is some benefits in that package. Just at a high level, the one of those benefits is there's $2.5 billion set aside in a grant program that makes funds available to build propane refueling stations, primarily, I guess, along the federal highway system, but in other significant, highly traveled areas as well. So beyond the refueling stations, there's two additional programs. One I think is $2.5 billion, and another is $1.6 that are both around or relating to school buses and other low emission transit vehicles. So converting those or updating those to run on propane.
Hey, Jim,
yeah.
Could I interrupt you for a minute? I have an incorrect presentation up here. I apologize. It was the last year, and I want to change it real quick if you don't mind.
Oh yeah, yep, you're right. I wasn't even looking at the slides. Sorry.
So, yep.
I think we're probably just on the second or third slide, probably.
Yeah. So let me do
I was trying to connect what you were talking about to the Paycheck Protection Program.
I looked up. I saw the PPP program. Yeah, thank you.
Yeah. He'll get there at some point, I guess. But yeah, thank you.
I'll keep talking, and if you can find the slides, great. If not, that's okay. These will be available to the group afterwards, so that's okay. There's a couple of other kind of programs that are part of the Infrastructure Investment and Jobs Act that relate to propane. One is a pilot program to get drivers in the ages of 18 and 21 out there driving in interstate commerce, just to alleviate what we've all seen as driver shortages, not just obviously in the propane industry, but kind of across the board. Port facilities, there's a focus there in this act to provide funding to reduce emissions at ports, to provide funds for tractors, materials handling equipment, and the like that run on propane. So the next piece of President Biden's proposed legislation programs anyway is the Build Back Better legislation, which I'm sure you've all been following and seems think is stalling in the Senate a little bit and seems to be, unlikely to pass in its initial form, if at all. But there does seem to be decent support for some aspects of that program, and that would include some of the energy-related aspects of the program. If that passes in some form, we could see an extension of the alternative fuel tax credit and other incentives for kind of renewable fuels, and I guess the term is qualified alternative fuels under the legislation, and that would include propane. So to be seen there, but it does seem like there is reasonable support for those aspects of that proposed legislation. Moving into kind of climate change and electric vehicle updates. Again, obviously, climate change initiatives, federal and state level, pretty hot topic right now, and definitely a top priority at the federal level in the Biden administration. They are setting a goal or talking about a goal of being net zero carbon emissions by 2050. That's an aspirational goal, so who knows? But that kind of drives what they're looking to put in place for measures to achieve that goal. One sort of approach is to provide incentives for electric vehicles. Tax credits, there's a tax credit available for up to $7,500 for the purchase of an electric vehicle, although that does fade out and go away depending on kind of the number of the types of vehicles that have been sold. I believe it's true that the credit is no longer available for Teslas, for example, because they've sold more than 200,000 vehicles. But the credit is still there for others, and I'm sure obviously we've all seen a large number of other manufacturers coming into the market with electric vehicle alternatives. Another aspect of EV incentives is funding in the Infrastructure Act for build out of charging infrastructure for electric vehicles. So we saw that with propane refueling stations, and there's also funds up to $7.5 billion over 5 years for this. $5 billion of which is directed to states to sort of implement EV charging infrastructure updates and expansions. We should be seeing later this year regulations coming out of the Department of Transportation, just kind of laying out the details to implement this program. There's a lot of kind of talk around how the infrastructure should be built out, whether or not utilities should be in there, or should it be focused on sort of existing convenience and gas stations, for example, given the fact that they are already located in the highest traffic areas. So I think that's something we'll see play out as the regulations get developed. Obviously, people in our industry would not like to see utilities get a hold on this, given that they, especially I guess if they can build the capital costs into their rate base and then charge kind of all ratepayers for it. It would be probably an advantage that would be hard to overcome. Just a few quick things on electric vehicles. Generally speaking, they're obviously the numbers are growing. Sales were up 88% in 2021, but they still account for only 3.2% of the U.S. car market. So it's a competitive force, obviously, but still at this stage of the game, very small. So we'll see where it goes, obviously. Charging is one of the kind of the biggest factors, I guess, with EV ownership. Many EV owners, 75%, typically charge at home, but that may be a function of the fact that the infrastructure isn't there yet. Tesla and some other manufacturers have obviously been building out their own infrastructure, but it's not quite as omnipresent as your neighborhood gas station yet. So that will be a thing to see. That'll be a big impact, I think, have a big impact on what we see for future growth. Range is another factor that a lot of people talk about with electric vehicles. Just how far can it go on a full charge before you have to pull over and charge again? Most go over 100 miles now, with many long-range options out there, 300 miles or plus. Although those ranges can definitely be impacted up to 30-40% by extreme weather conditions, real hot, real cold. If you're running the heater or the air conditioner a lot, you're going to get less range. So that's a negative factor for a lot of people considering getting into the EV market. There's a lot of R&D and investment going on right now for making longer range batteries, because for a lot of people, that's one of the biggest hurdles. Charging time is kind of a related hurdle for people. It can, depending on your source of charging, it could take hours to charge your vehicle. Others can get you to 80% or so within about 20 minutes. And again, a lot of R&D here too, along with battery life, is charge time, trying to bring that down. We have seen recently traditional oil and gas companies like BP and Shell investing heavily into the charging infrastructure, which I guess is a pretty clear sign that they see that as a coming thing that's not going to go away, and an area to take advantage of and maybe become profitable. A lot of mixed opinions on sort of the overall greenhouse gas. You'll hear a lot of people talk about electric vehicles not really, in the end, being better for the environment, or having fewer emissions or greenhouse gas effect overall, when you include things like battery manufacturing and disposal. And it also depends on, obviously, the source of energy that you're using to charge your vehicle, which can vary from location to location, whether it's sort of old, dirty coal, or is it, new, supposedly clean wind and solar. There are a few other, and I'll skip details here because I can see that we're almost up against the clock, but a few other initiatives that are either in place or on the drawing board, or will probably be expanded in the near future, is just low carbon fuel standards. This focuses on carbon intensity, which Spencer had alluded to earlier. Things like clean propane would be a low carbon intensity fuel. Cap and trade programs is another these are programs that are already in place in some states and regions. RGGI out in the Mid-Atlantic is one example of that. Renewable fuel standards, which the focus here is on blending of biofuels. Again, these are in place in certain places. I don't think we're going to get to data privacy. I'll wrap up with just the state and regional carbon markets programs, which really are not much different than what's being proposed at the federal level, but there are a number of those that have been in place for a few years or are being talked about now. Most of them are along the same lines as the federal programs. Cap and trade, for example. There has been, I think, recently a lot of kind of debate about the cost benefit of those. Some would say that all that really does is lead to increased costs for utilities, which gets passed on to ratepayers without much actual benefit in reducing emissions. So I think the jury's out on those initiatives, but there are enough of them out there in different regions of the country that I don't think they're just going away. I think I should probably wrap it up there, right? I see we're at the top of the hour.
Yeah, well, I appreciate that brief update that you gave us in the time we had, Jim. And for the audience, there's some good slides in here on cybersecurity. We'll send this deck out to you. I know both Spencer and Jim could have talked for hours here, but I appreciate you guys being succinct. And hope you found this to be valuable. Again, they're more than happy to follow up. We'll get you their contact information, but with any individual questions that you have. And I just want to say thank you for your expertise, Jim and Spencer, and willingness to share with us. the dynamic marketplace that we operate in, and even on the legal front, how much energy do we use, what type of energy, and how do we pay for it are all very significant questions that impact our livelihoods as well as society's standard of living at the same time. So difficult questions to grapple with. Well, we look forward to the next webinar. And again, thank you, Jim and Spencer. Goodbye, everybody.
Thank you.